It is very important to know that you don't use your stop loss level for every signal or every analysis to determine how much you're going to lose in the trade, whereas you use how much you're willing to lose per trade to calibrate your stop loss. And that is what I want to show us. Risk management has to be one of the most underrated trading techniques that is ever being taught. I mean, if you're coming into trading, the first thing you should be learning is risk management. There is nothing so important about candlestick charts and all those things. Like, you need to manage your risks. In fact, you need to learn not to lose money. We've had examples from worldwide traders, successful traders worldwide. If you're a beginner taking signals or you are already trading, I'm going to be showing you how not to get liquidated. And this is especially on how to calculate your leverage and your stop loss. If you master this thing that I'm going to share with us, then you have elevated your trading game by 60%. If you've watched to this point, then I believe what I'm saying really interests you. Please subscribe to my channel, and I want you to help me like this video and drop a comment. Without further ado, let's go straight into it. Let's say Mr. Nat comes up to give you a trading signal, or Mr. Nat is saying buy this token, long this, short this, do this, and there is a screenshot to give you a picture, an entry point, exit point. And how do you take this trade without being liquidated? No matter how new you are to trading, there is a proper way to manage your accounts that would help you not blow the money ever. And this is the risk ratio management. Crypto guys do not really make use of this, but I tell you, forex guys are big on it. 1-to-2 trading ratio or 1-to-3 trading ratio. This is a very big deal. It is very important to know that you don't use your stop loss level for every signal or every analysis to determine how much you're going to lose in the trade, whereas you use how much you're willing to lose per trade to calibrate your stop loss. And that is what I want to show us based on this 1:3 or 1:2 trading strategy. And this rule is simply saying that I am risking 1% of my capital, and in turn I want to make 2% or I want to make 3% of it. So if you're trading with $1,000, for example, 1% of $1,000 is $10, and then 3% of $1,000 is $30. Okay, now if you don't even want to do 1:2 or 1:3, you can do 2:4 or 2:6. It's still fine, because a lot of crypto futures traders, what you do is just pack money into your trading and then boom, it is gone. You don't apply most of these principles, and it is very, very important. If you have $1,000 account, 1% is $10, and the $10 now would be how much you're willing to lose per trade. So no matter how the distance of your stop loss is, you want to make sure you do the right calculation that would help that $10 meet up where your stop loss is. Before I show you how this looks like in a chart, let me help you understand how leverage work, how position sizing work. We have like 1x, we have 2x, 50x, some pairs even have 100x like BTC. And what is happening here is that you are borrowing money. Let's say you want to enter a position, and instead of using 1x, because when you use 1x, it means everything you're going to be using to your margin now is 100% your money. Okay, your margin is 100% your money when you use 1x. So the amount you're going to be paying for that, the cost of that trade is going to be 100% your money. But when you use like 10x, for example, you are instead of paying 100% of this, you're going to pay 10%. And now, if you're using 100x, it simply means you're paying nothing. You're almost borrowing 100% of what you're going to be trading with. And when you do 100x, it is actually very profitable when you begin to go the positive way. But when it comes down or it begins to go negative, you are losing. This risk is too much. Remember what I said, when you're using 1x, it's just like you're paying for the trade that you do. You don't borrow any money. You pay 100% from your capital. When you do 10x, you're literally going to be paying 10%. And 10 times 10 is 100, yeah? When you do 100%, 100x, it means the 100% here is going to be is not going to be yours. To help you, not blow your account ever, you really want to understand position sizing. And to help you do that, I want to give an illustration here. If you have a $1,000 account, and you want to go into trades, first of all, you have to decide how much you are ready to lose. Do you want to be using 1:3 or 1:2 or 1:4 or 2:4 or whatever? Now, if you're going to be using, for example, 1:3, and I give you, let me take this off, and I give you an analysis, or you make an analysis, your stop loss is here, your take profit is here, and this is your entry point. This guy is supposed to be 1%, and this guy is supposed to be, let's say, 3%. This is 1:3. So if the price goes here, you are only going to lose 1%, and if the price comes here, you are going to make 3%. So it means you are shorting this market here. Now, at the top of every stop loss, I'm going to show us this on the trading view. At the top here, there is always the reading percentage from your entry point. So let's say what it's read up here is 1.3. Okay, and here you are getting 3 points, maybe 3.2 or something, because sometimes it might not be exactly this 3%. So let's say this is 1.3, and remember you're using $1,000 as your capital. What you're going to do is you want to calculate how much would you use for your entry so that you would lose 1% of your capital. 1% of your capital is $10. Yeah. How much are you going to use as your margin so that you would lose just $10 when the price gets to this stop loss, and then you make $30 when it gets to this place? Let's say 1.3%. This is also equal to 0.013. Okay, so we're going to be making use of this guy. Remember, we are trying to calculate how much would be your position size for a $1,000 account. Yeah, so we're going to divide this $10, which is the 1%, divide by 0.013. This is equal to 769. Okay, so if you want to use 1x, for example, it means you're going to be paying 100% from your capital. That is 769. But if you want to use 10x, for example, it means we are going to divide this guy by 10. So what you will be paying as your margin, your initial margin, or the cost for this trade would be $76. So you see that using 10x has allowed you to borrow more money so that you can pay just $76 as a cost. Meanwhile, if you're using 1x, you're paying everything from your balance, which is 769. Now that you know the cost of a $1,000 account when you're going into a trade like this, let's do for $100, and probably you can begin to practice depending on how much you have or how much you're trading with. Let's say your capital right now is $100, and 1% of $100 is equal to $1. So for every trade, you don't want to lose more than $1. Yeah. All right, we are still going to use this as an example. So our stop loss is 1.3%. First of all, 1.3%, like I said, is also equivalent to 0.013. Okay, so we're going to divide $1 by 0.013. This is equal to 76. So just like I explained earlier, if your leverage is going to be 1x, it means you're paying 100% of your trading cost, which is 76. So you're going to buy this trade, or sorry, you're going to sell this trade, using 76 as your cost, so that when it gets here, you will lose just $1. But if you are using 10x, you would have to divide this guy by 10, which would give you $7. So you're going into the trade on a 10x leverage with $7, so that when it gets to this point, right, you will lose just $1. I hope this is very simple and well understood. It is possible to use 2:4, for those of us who want to increase our risks, but it is all dependent on what you want. If you're using $100 and you want to use, let's say, 2%, you want to risk 2% or 3% of your capital, it is still possible to do that. You can say 2% of $100 is $2. The next thing you need to do is we're going to divide $2 by 0.013, okay, which is equal to what? 140, 152, which is it is 152. Okay, what is this? 152. This would be on a 1x, you're going to be paying 152, as your cost for that entry. But on a 10x, you're going to be paying this divided by 10, which would give you 15. Okay, I think 15.2 or 15.1 thereabout. So on a 10x, this is what you are expected to pay for. And on a 5x, yeah, very important, on a 5x, you're dividing 152 by 5. Whatever it gives you is what you're going to use as your cost. A lot of times we just want to make plenty money, and that's why we use high leverage and high margin. But for a $100 account, you definitely would not want to go into a trade and lose $10 at a stretch, or even $20. That's high of a risk for you, because there are several opportunities in the market. So you need to be patient and find the one that would give you more profit, instead of rushing into it and your money rush out. I mean, you rushly lose your money. I believe this video was helpful. Please like, drop a comment, and also share. Thank you for watching.